Tax season is here, and if you are looking at your tax returns and either you owe the IRS or you want to maximize how much you're keeping, this is a conversation you want to check out. We're going to talk about ways to save money on your taxes, and particularly how to use apartment investing to help you do that. Hey, what's up, guys? It's John Casmon here, apartment investor. I've helped others invest in over $150 million worth of apartments, and one of the main reasons people love apartment investing is for the tax benefits. So if you're like me, you just kind of finished most of your taxes, got most of our K1s out, now doing my personal taxes. And tax season is one of those things that we all have to go through. You know, there's that old saying about death and taxes, the two truisms of being alive. And that's something that we all have to understand. You know, it's not really about how much money you make, it's how much money you keep. And having to give 30, 40, 50% of that to Uncle Sam, that can absolutely stall any kind of growth plans you have. So having a sound tax strategy separates those who achieve their financial goals and those who suffer. So let's talk about what that looks like and why apartment investing is so alluring to so many people. First of all, let's understand the tax system at a high level. And I'm not a CPA, not really a core tax guy, so I'm not going to go too deep in this. But taxes are really focused on a couple of things. One, it's a way for the government to pull dollars from the masses to spread things or spread money so that you could pay for, you know, the roads, schools, things that help the overall community, libraries, all that kind of stuff, right? So that's good. But we obviously know there's a bunch of different programs, and some of those programs people may agree with, people may not agree with. I'm not here to get into all of that. Here's the thing. I don't really care about the taxes. I do care more about the tax code. And the tax code signifies what the government is asking us to do. And the tax code is written in a way that rewards certain behaviors and punishes other behaviors. In particular, the tax code is written to reward business owners and entrepreneurs. And it penalizes those who work in corporate America, W-2 employees, right? And you may be saying, oh, that's not fair. And I get it and I understand your point. But think about it like this. Most people do not want to go out there and take big risk, launch a brand new business, invest in anything that could go down in value or could lose money completely. And we know that properties, they get older, they need investment, right? They need people to put money into it. So the tax code is written in a way to incentivize people to do certain behaviors. And that incentivization is really, really key. When you think about the tax code, the main thing you have to understand is really about incentives. That is what the tax code is. It's incentives to elicit the kind of behavior the government wants. That's why you have, certain grants. That's why you have tax credits. That's why you have tax breaks. That's why you have things like depreciation, amortization. All this stuff is written in a way to reward those people who are willing to go out on a limb. Now, why would they do that? Well, here's why. Because the government providing jobs, the government providing housing, the government providing food is never going to be top tier. I don't know anybody who loves government housing. I don't know anybody who loves the food, government food and being on government food programs, right? So not to say that vouchers don't help people or anything like that. I'm not talking that. I'm talking literally like government cheese. Like when I grew up as a kid, that was the joke. If you were on government cheese, that was you got clowned on that, right? It was never the best quality cheese. I can promise you that. So here's the thing, right? The point is the government doesn't want to provide these things. So they created a system to incentivize others in the private market space to go ahead and do these things on their behalf. So they say, hey, we're not going to do this, but if you guys do this, we'll give you this reward, right? It could be a tax break, could be something else, but that's how it's written. So when you understand that the tax code is really about incentives, now you understand why it's written the way it is. So now think about your role as an investor. When you're investing in apartments, what are you actually doing? You're providing housing for people, right? These are people who maybe can't buy properties themselves. They couldn't be homeowners themselves right now based on their situation. So what you're doing is you're providing apartment units for people to live in. So instead of government housing, you are now coming in and providing housing. So you're helping it, right? This is the private sector helping people and help keep things running. This country runs off capitalism, and it's not necessarily just this notion of the ability to make money in a free market economy. It's understanding the role incentives play where people can go out there and do some of the heavy lifting and not rely on the government. So that's exactly what this incentivization is about. It's about getting people to go out there and invest in apartments so the government doesn't have to. And due to that, they're willing to give you some tax breaks. And this is where you come in. Even if you are a W-2 employee, even if you aren't necessarily a builder and creating brand new properties, by owning these real estate projects, you can get some of the tax codes and tax breaks that exist. So what does that look like? Well, first of all, you understand there are certain investments that you can make, right? So apartment investments, there's other, commercial real estate you can invest in, but for right now, we're just going to stick to apartment investments. So with apartments, you have this ability now to do depreciation, which you can do on pretty much any real estate. However, there's bonus depreciation where you can accelerate that loss over the lifespan of this property and take all of it in year one. Now, this is one of those things that was implemented when President Trump came into office the first time. And this was the first time that they've done this. And that really sparked people to go out and invest because they could take what we call paper losses, meaning on paper, they're going to show that they lost money, even though we know, generally speaking, real estate property tends to go up in value over time. So that was something that triggered a lot of investors to get in because they could go out and instead of having to lose money or pay money to Uncle Sam in taxes, they could show that they actually lost money and it lowered their tax obligation. Now, you might be saying, oh, it's a tax loophole. And I hear you and I understand the logic, but I go back to understanding one thing. What is the point of the tax code? It's incentives. When people are out there, now we got development. We are at a housing shortage, and this actually triggered the most amount of new apartment supply that we've seen in 40 years. So you have to have incentives to get people to take the actions that you want. And this was one that actually sparked the economy for a number of years. Now we're in a different market cycle where we're starting to get into a softer economy and starting to have some challenges. But again, tax code is written for incentives and to incentivize the behavior we want to see. We saw that with this bonus depreciation. So you as an apartment investor, you can take that. What does that look like in real numbers? Now, it's going to vary based on every investor and the investment. But I'll give you a real world example. On one of my deals that I did a couple years ago, we bought the property and all of our investors who partnered with us on this deal, if they invested, and I'm just going to use a round number, $100,000, they invested $100,000. They received a paper loss. So on our K1 statement, which is their shares or their equity portion of the investment, they received a paper loss of about $60,000. Okay. So you invested $100,000 on your tax return. It said minus $60,000. So if you had other passive income, you could actually offset that with this loss. So this is a powerful tool. You're somebody who's out there making money and doing other means, or you have other passive income. This is a great way to offset those capital gains and keep more of your own money. Now, this starts to get pretty complicated. And for most people, I would advise you to talk to your CPA because you want someone who really understands the tax code to tell you whether or not this applies to your unique situation. For some people, it does. For some people, it does not. So understand the tax code, talk to your CPA, and find out if this is a strategy that can help you. Now, that is just the bonus depreciation component. Now you get into the lifespan. You get cash flow, you get appreciation, you get the depreciation component, and you get leverage, which is typically taking out a loan. You don't normally have to buy the whole property cash. So you can leverage a bank loan. So now you've got more upside in this property. So this is one of the reasons people love real estate, right? Particularly when it comes to apartments, is you get all these benefits locked together. And that is something that is unbeatable. So as an investor, when you are looking at your tax situation, ask yourself and talk to your CPA, is this something that can help? And if you think it is, you are in luck because this is the kind of thing we help investors with all the time. We are apartment investors ourselves, and we do partner with busy professionals to invest in apartments where they get a chance to take advantage of all the perks of owning real estate without any of the headaches of being a landlord themselves. If you are interested in learning more, I advise you to take a look at our 7 questions you must ask before investing in apartments guide. This guide gets into some of the key questions you might be thinking right now. How do you know which property to look at? How do you know which markets to invest in? How do you know which operator, what people you need to be investing in or partnering with? These are all the kind of questions that can either save you or derail you on a deal. So if you want to learn more, check it out. It's on our website, casmoncapital.com/7questions. We'll also put a link to it below in the notes. So when we talk about taxes, we talk about K1s. A lot of investors say, well, how does this work? Like, okay, this seems kind of complicated. How many investors are in a deal? There's lots to understand and unpack here. A couple things here. Think about it like this. If you were to invest in, let's say, McDonald's, okay, you're going to buy shares of McDonald's. You don't know how many other investors are in McDonald's, right? But it doesn't necessarily sway your decision to invest in McDonald's, right? What you really need to know is who's leading McDonald's, what's the business plan, like what's the competitive landscape. You want to understand that property or that investment itself, not necessarily how many other people are partnering alongside you. With that said, you definitely want to understand, what does this look like? Who's making the decisions? Are there other people who could weigh in? Are my shares going to be diluted by any chance? These are the kind of things you want to understand. And typically with apartment syndications, which is the vehicle that we use to put these deals together, your investment is not diluted. Okay. When you invest in these deals, you're going to have shares of the property. You're going to know the total amount that's being raised. Let's just say somebody's raising $5 million. If you invest $500,000, you've got 10% of the shares there, right? So that's something that you're going to want to understand is, what is the raise amount? How many shares you're investing in? That's going to let you know how many shares you actually will own in that investment. And in that case, you may be doing maybe $50,000, right? Not 500. So in that case, you're going to own 1% of the shares. So you're doing a $5 million raise. You're going to invest $50,000. You're going to have 1% of the shares, right? So those are the kind of things you want to understand. What's the total raise? What's your share? And you have to come up with your own investing thesis. I like to tell people, you never want to be over leveraged or in a position where you're the majority investor, especially if you're newer, right? If you own that deal outright, that's a different story. But one of the benefits of investing in a company like, say, a McDonald's is you know how massive they are. And there's a lot of other smart, savvy shareholders who are involved. And if something's wrong, many of those people will call it out. When you invest in, say, a flipper, it's just a dude down the street who you know or who you talk to, you're putting all your eggs in that basket and hoping this guy is good. When you invest in a syndication, and I'm not saying that they're all equal, they're not. You still have to do your homework. But when you invest in a syndication, you at least are investing alongside of people who are also looking at the merits of this deal, who are also going to be asking critical questions. And together, you're going to hold that operator to a higher standard as far as what the operations need to look like. And in theory, at least in theory, that should net you better results. You also want to understand the underlying investing thesis, right? If you're investing in flip properties, a lot of times these are very distressed properties. They need a ton of renovation. And after that renovation is done, someone's going to sell the property, really not getting any cash flow, really not getting any of the tax benefits. So you're really just going out there and hoping that there's enough upside in the marketplace where this property is going to be valuable and make you some money at the end. When you're typically investing in apartment syndications, you're usually buying a property that is cash flowing. That's our number one rule. Make sure the property is cash flowing. I can't tell you how many times people buy properties where the cash flow is actually negative, meaning the person is losing money every month on this property, but they have a plan to turn it around and make money. Well, sometimes those plans don't come to fruition, and that's where things can get bad. So one, start with a property that's actually cash flowing. If you start there and then you also have a plan to make it make more money, that is a great way for you to create value. And even if you're wrong, you still have a cash flowing asset, assuming you protect that downside. So those are the kind of things that I'm looking at when I'm investing. So I want to understand where that property is, what the upside is, and how I protect my downside. And again, if you have other investors who are more seasoned and they're investing alongside this deal as well, there's strength in numbers. Okay. Again, in that scenario, you're investing $5 million to buy this property total, but your investment's only $50,000. Your 1% of this investment That means 99% of the capital is coming from other people who are also going to be looking at this deal, who are also going to be asking tough questions, who are also going to be holding this operator accountable for the performance of this asset. So there is strength in numbers. I know sometimes people get a little intimidated when they're big numbers, but think about it as the difference of investing in a company like a McDonald's or a big company that has a lot of shareholders and, a Johnny's Burgers, who is a local mom and pop. And maybe Johnny is, working the cash register. He's also the chef and he's also, running deliveries, right? A lot of room for error or for things to go wrong because Johnny's doing everything. With McDonald's, there's an infrastructure. There's enough money flowing through to run it professionally like an organization. And it's the same thing with apartment syndications. You want to see that there's staff. There's a property manager that's on site. You want to see that there's a maintenance technician on site. You want to see that there's a leasing agent on site. You want to see that there's a team to run the day-to-day operation. And the people that you're investing with are operating at a high level, a senior level, and they're really overseeing the operation as asset managers. You don't want to invest with a guy who is also the property manager. He's also the leasing agent. He's also the maintenance technician, because there's a lot of room for error and nobody can be great wearing all of those hats at the same exact time. So that's really the difference in investing, is making sure you're investing in an enterprise that has the ability to drive success due to the scale of the organization, as opposed to investing in something where it's truly just one person. And if anything were to happen to that individual, your investment goes up in smoke. So I hope this is helpful when you think about it. Through those investments in the apartment syndication, it is still treated just like you own the real estate itself. And this is the part that a lot of people don't get. So in most deals, when you're investing and you're passive, meaning somebody else is doing the work, well, you're investing, let's just say you're investing in that flip project, as I alluded to. All right, you're giving this person the money to flip a property. Well, you're not really an owner of that property. You're an investor, you're capital, but you don't own that property. So they're going to get, if there are any tax benefits, which usually there aren't, they're going to get them. In these deals with the real estate syndication, you own shares of it and you will have direct ownership. Unlike in a REIT where you have shares of the REIT, but the REIT is another business that, has investments in these other properties. The tax benefits have already been taken at that REIT level, so you don't get the pass-through benefits to you and your personal taxes. In this case, with real estate syndications, you do. So on that K1, like I talked about before, if there is a paper loss, you get to take that paper loss for your own personal taxes. And that is the thing that sets apartment syndication apart from a lot of other investment vehicles. Now, if you want to learn more about this, again, check out our website, casmoncapital.com. We also have other great content, great videos that get into apartment investing, syndications, how to select deals, how to select the operators. So check out some of the other videos on our channel. We'll talk to you next week.